Okay, everybody, I believe that you should be able to hear my voice now. I believe the chat is also active. So in my mind, everything is back to normal, and hopefully we can have a normal session in front of us. Please confirm with a quick hello, a quick yes that you hear me, that you see me, etc., so that way we can start, okay? Thanks a lot, guys. Yeah, that's great. Perfect. Very good. Well, as you know, today I'm using a different technology to be able to share my screen with you. We didn't connect exactly the same way we have been connecting prior to today. We have been using a different URL, a different link. We are channeling everything via YouTube into the session, and this implies a different software on my side. And I guess this is the reason for the little bump in the road when launching today's session, okay? But anyway, it's Sunday, guys. I'm sure that we are eager to sharpen our skill. Also, I'm sure we are eager after the session is over to spend time with families, etc. So let's get started. So 24th of March 2019, that's today. We are getting together for sharpening. My name is Jose Blasco, a pleasure to be your guide. Let's go for disclaimer. The following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Good. So we have our disclaimer out of the way. The way I would like to begin the session today would be to bring back to the table a Word document that we have been putting together that talks about options, and we've been building all of this together little by little. Today is going to be, if I'm not mistaken, session number 7, talking about options, okay? And I would like to begin the day today, looking at key aspects of this document very quickly as a nice reminder, so we can then jump in here today, most of the days, I should say, where some of you have traded options before, some of you haven't, etc. And I want to make sure that we are all on the same page, okay? So also, even one step before that, I would also like to share an email that we have received from one of our app users. And again, loving to share those emails because, sometimes some of those emails make us very, very happy. Sometimes those emails serve as examples of what to do. Sometimes those emails serve as examples of what not to do. So from time to time, in a regular basis, I will be bringing some emails from other app users into the environment, into the virtual room here, so we can learn from the good and the bad experiences and the anything in between. Okay, so this is Supply and Demand Trader sent us this email yesterday. So I'm not sure if you are with us, Supply and Demand Trader, but if you watch this recorded, thank you very much for the email. If you are with us as well, thank you very much. So it says, "Hi Jose, just a quick note to let you know that I was trading along with you." Oh, sorry for that. Translation just loaded in the background. I was trading along with you this week. I was filled on the Tesla credit spread after Thursday's predictive session, and the spread expired worthily yesterday, so I received the full credit. Okay, and this was the last trade that we planned here, where we were planning on an iron condor. The vertical line is the day when the trade was executed, and we were using an option. We were using options that would expire 2 days from that day, which that was the Thursday, and the following candles here on the right, that was the Friday. And the expectation was that Tesla would remain trading somewhere in that portion of the chart between the two blue lines, okay? Because in the lower time frames, we had identified UFOs above, UFOs below, so we expected price to stay between, okay? And sure thing, that's what happened. And again, nice application of options, and that's one of the reasons why I bring this email into our conversation. Nice application of options here. with the credit strategy, selling credit spreads or iron condors. It's what we call credit strategies. So supply and demand trader said, for me this was an ideal trade as it was very short time to expiration and high probability. It is great that we are earning while we are learning. Love that too. I particularly like the way AutoUFOs allows us to have a clear objective view of probabilities. Very, very impressive. This is something I would not be able to do without this tool. Thank you for the 3 weekly mentoring sessions. They are greatly appreciated, very useful and profitable. Taking just 2 Tesla spreads more than cover the monthly cost of the AutoUFOs. And I actually took several more spreads, so I'm very happy. Best wishes, and see you at the next session. So, we are happy to see you're happy, but really, this makes our day, and in the sense that, you guys are using the tools, you're putting the discipline, you're putting the time to join us in this get-together session. So well deserved as well. Okay, and thank you very much as well for sharing Supply and Demand Trader, because you may realize this, you may not realize this, but especially among the traders in the group here, where some of you may have been trading for a while, but for the ones that have not been trading for so long, so one thing that is imperative for you to be able to gain consistent results, and those results to be of a significant size, is that you become a confident trader, meaning that you trust your abilities and your skill. And obviously this could not happen without certain level of practice or guidance. And it's great that you share this email, because I'm sure that some of you joining us today maybe have attended a few of our sessions, but maybe you have, or maybe you haven't executed any trade. And it's important that all of you realize that practice makes perfect. In this case, what I mean is that developing that ability and confidence on your ability comes from the practice. Okay, so great example of one of you applying the practice and gaining the benefits of it as well. Okay, so thanks a lot. So anyway, back to our Word document here. So again, we've been talking about options. This is session number 7. So I'm not going to go back to page 1, but I would like to go back to the last notes that we made. And probably you remember I've said that before, but just in case you are joining us today for the first time, the way we have been conducting sharpening skills since we started in November here has been, kind of like this approach of like, pretend that instead of me being the instructor and you being the students, pretend that it's uncle and nephew, right? Or uncle and niece, or father and son, something like that. So how would you teach your kids to trade? Well, probably you would sit in a table, right? And you grab a piece of paper and you start making notes or doing drawings to explain certain things, and then you would jump into the charts and do it, right? So it's kind of what we have been doing. Instead of giving you a pre-made kind of like page of paper with everything written in it already, what we have been doing is that we have been typing all of this along all together, because I believe that it takes a little more time, but at the same time it does provide a greater photographic memory. Many people, most people actually kind of like remember more than the content, the experience on how you got to the content. And the fact that we type it together, hopefully is helping you to do that, okay? So what did we do on the last week? Well, on the last week, we went deeper into debit spreads. That's what we did last Sunday. And the one thing that we never covered was the credit spreads, which I have them there ready for us to cover the credit spreads today. But very quick, okay, what is a debit spread? Well, it's a spread. And what is a spread? Well, a spread is when you combine 2 options together at the same time. Okay, so you may want to watch the session that we did 2 weeks ago if that's not clear. But remember, when combining 2 options at the same time, you could end up in 2 different scenarios. Scenario number 1, you buy an option of a higher price value, let's say 5, and you sell an option of a lesser price value, let's say 3, and therefore you pay 5 and you collect 3, so you end up with a net debit of 2. So a debit spread is when you use 2 options combined, where the one you purchase is of a higher price than the one you sold. Therefore, you end up with a net debit. And of course, if you use calls to do that, meaning that you buy a call and you sell a call, well, then you ended up with what is known as a bull call spread, which is a vertical spread that allows you to make money directionally and only if the move goes up. In other words, you are directionally bullish. If instead of using calls, you did it with puts, where you bought a put of a higher price value and you sold a put of a lesser price value, you just built what is known as a bear put spread. It belongs to the family of vertical spreads, and this would make you directional and bearish. So you would be expecting the market to fall, and you would only profit if the market does fall. Okay, you are directional and bearish. So this is the world of debit spreads, and this always happens when you pay. So even if you didn't do a spread and you simply bought a call or you simply bought a put, because you pay, you need the market to move your way for you to profit. Why? Because you paid. So because you pay, you start, let's call it at a disadvantage, okay? Because you paid, okay? It's not gonna be a disadvantage, because you probably remember that when we went over our scanning tools here, you probably remember those scans that we have right here on the left side of my screen, isn't it? So when we do those scans, one of the parameters of the scan was to look at the 25 to 50 stocks in the market with the cheapest options as possible. So yeah, you do start with a disadvantage by paying, but you have paid for the cheapest options in the market. So the disadvantage is not that big as a disadvantage. And now, as long as the market moves, you start profiting. So the debit spreads are, let's put it this way, fantastic. If you do it at the right time, with the right timing, with the right UFOs, etc., it's amazing, okay? But what about the credit spreads, okay, which is the subject for today? Well, the credit spreads, it's a little bit of a different story. Actually, it's still a spread in the sense that we're gonna use two options combined. So from that point of view, it's not gonna be that different. But it will actually be quite different. And the reason why it's gonna be quite different, it's because you will not produce a debit, you will produce a credit. And a credit means that you sold an option of a higher value and you purchased an option of a lesser value. So if the option you sold pay you 5 and the option you bought, you had to pay 2 to buy it. So you ended up with a credit of 3. And what does that mean? If you get paid 3 as a credit, it means a few things. What is the first thing it means? It means that if the market moves in your direction, the options will expire and therefore you will make 3. That is one thing it means. So when you do a credit spread, okay, there is a directional component to it. Okay, so when you do a credit spread, okay, there is a directional component, okay, just like when you do the debit spreads. Okay, let me compress a little bit all the text I have on the screen, because I would like to put it all together. So then when I'm done typing, you will be able very nicely to compare the debit and the credit spreads, and you will see it's going to be crystal clear in our mind. Okay, so when you do the credit spread, just like when you do the debit spreads, we got a directional component. Okay, directional component. Okay, so since I got written here from the last session, bull put spread, and obviously the word bull means you are bullish. Okay, so when you do a bull put spread, you're going to be directional and bullish. Okay, because again, when you do the bull put spread, you sell a put of a higher value, you buy a put of a lesser value. Okay, so you sell a put of a higher value and you buy a put of a lesser value. So you end up with a net credit. Okay, this is also known as a vertical spread. Okay, vertical spread, because both options belong to the same expiration date. You probably remember this from the last week. If not, please make sure you watch last week's video. Okay, so now credit spreads can be directional and bullish, just like the debit spread. Okay, just like the debit spreads, but they can also be less directional. Okay, they can be directional and bullish, or they can be directional and neutral. Why? Well, because let's say you sell the bull put spread, and let's pretend that that stock, that market, that ETF, that futures contract, that whatever you use with options, let's pretend it just doesn't move at all. It stays in the same place from today all the way to the expiration date. It doesn't move, just stays the same. Well then, even though it didn't went up, what happens on the expiration date? The option still expired. So what happens? If the options you sold and bought created a credit of 3, and the stock didn't move, but time passed, and you went to expiration date and the options became 0, so what happened? You made $3 of profit even though the stock didn't move. So that's what the word neutral means. Okay? When you say bullish, only bullish without neutral, it means that you need the stock to move for you to profit. It has to move. But when you are neutral, what does that mean? It means that it doesn't have to move. Okay? If it moves, it's fine, but if it doesn't move, it's fine as well. So think about the 3 different possibilities for price movement. You can have a stock to go up, you can have a stock to go down, and you can have a stock to go sideways. Well, if you are bullish with the debit spreads, right? Well, the name says it all. You are bullish. It has to go up for you to profit. In other words, out of 3 possibilities, which is to go up, to go down, or to do nothing, stay sideways. So you need 1 out of 3 possibilities for you to profit. Where if you do the credit spreads, right? You make money if it's bullish or neutral. In other words, if it goes your way, even though you lose, you got $3 to limit the size of the loss. So if you end up losing 5, well, 5 is not going to be your loss. It's going to be 5 minus 3. So you end up losing 2. Why? Because you got paid 3 to lose 5. So you end up losing 2. So, in other words, out of 3 possibilities for price movement, which is up or down or sideways, the credit spreads will pay you in 2 out of 3 cases, where the debit spreads will pay you in 1 out of 3 cases. So from a purely probability point of view, credit spreads could be a higher probability type of strategy. And by the way, it's exactly what it is. Just like if you close your eyes and you forget about the world, credit spreads are higher probability compared to debit spreads because you profit in 2 cases instead of 1 case out of 3. Now, of course, it's not like we have no tools to identify price movement and direction. We have the UFOs. So, if you have a good trade with, a couple of nice UFOs overlapping each other, which are dark color, which means higher probability, which, you have a confluence with moving averages and, a series of things are happening, right? And it's a high probability trade for the market to go up or down. You can certainly do a debit spread and it's amazing. And by the way, when I say amazing, I mean it because here's the difference between the debit and the credit spreads. Here's another difference for you to keep in your mind. If you do a debit spread, yes, you start at a disadvantage by you paying. We talked about that before, even though, again, we shoot for the cheapest stocks in the market. So it's not really a disadvantage. But, you do have a disadvantage. Well, yeah, but wait a minute. If the stock moves, and it moves a lot, the more the stock moves, the more I make. So I could potentially make a lot. So my disadvantage is to pay. So I start at the disadvantage. But then if the stock does move the way it was expected thanks to the UFOs, then the potential for profitability is to the roof. Okay, so that could be a very, very, very powerful trade. Now, on the other hand, you have the credit spreads. Well, let's say you do a credit spread and you get paid 3. Well, what's the beauty of the credit spread? That you have a higher probability of profitability. Why? Because, you profit in 2 cases out of 3 instead of profiting in 1 case out of 3. So it's higher probability by definition. But what's the downside? Well, the downside is that if your credit spread pays you $3 per spread, the most you will make is $3, no matter if the stock stayed in the same place or the stock moved $50 for you, it doesn't matter. You only made 3. Why? Because it's a credit spread. So, this is like if you were to trade without options, if you were to trade futures or Forex or stocks, typically you would have this impact, between if you were to compare the probability, the risk and the reward of your trades, you would have this, let's call it correlation. For example, if you go for trades that are 1-to-1, typically the probability would be very high. If you wanted the trades to be 20-to-1, the probability of these to be found and these to work, it's much less, right? So when the trade makes more money for you, the probability is less. When the trade makes less money for you, the probability is more. And I would say that this is just life. Okay, it's trading and it's life. That's the way it is. Does that make sense? So that's exactly what we see as well in the world of debit spreads and credit spreads. Okay, so right now I'm just explaining what is a credit spread, because after I'm done with the explanation, we'll talk about how to build it. Okay, and then we'll spend the whole remaining part of the session building debit spreads and building credit spreads, and it's gonna be fine. Okay, it's gonna be fun. So now, what if instead of directionally bullish, you want to be directionally bearish / neutral? So what would you do? You would not do a bull strategy, you would do a bear strategy. And it would not be puts, it would be calls. Okay, because remember, if you do the bear put, well, the bear put is up here, and that's a debit. So if you want to be bearish, you have to be the bear call, right? And therefore, what you would do is that you would sell a call, and you would buy a call. It's the complete opposite. It's so simple. This is like the mirror image, okay? Having said that, after I said it's so simple, I totally understand that if I read this very quickly and I say bull call spread, bear put spread, bull put spread, bear call spread, well, probably some of you, if you haven't never traded options before, you're gonna be like, oh, wait a minute, that was too fast, let me think. Okay, so yes, at first it's a little confusing because it's just like kind of playing with the words, and there are different combinations that are possible. But please don't be overwhelmed. If you feel a little overwhelmed, please don't be. Because the moment you practice this for a while and you take a few trades with it, this will be embedded in how you think for the rest of your life, okay? It's very simple. By the way, if you ever get confused, here's a little trick on how to remember it. Always think about the debit first, okay? Because the debit is kind of like intuitive, okay? Buying stuff, paying for stuff is intuitive. We do that every day when we go to the supermarket, correct? So think about debits, right? And let's say I ask you, and remember, debit means buy, okay? So let's say I ask you, what do you want to buy for you to be bullish? A call or a put? What the answer would be? Well, it's obvious. It's a call. If I want to be bullish, what do I buy? I buy a call. So in other words, when you do debits, which means you buy, if you want to be bullish, so what are you going to use? Calls. And therefore, the strategy that is bullish that you just call is called bull call. And it's a debit. Why? Because you buy calls. And that's what you do when you are bullish, buying, right? Let's say you are bearish, and I ask you the question, what do you buy if you're bearish? You would say, I buy puts, right? So if you say I buy puts, then you are bearish via buying puts, but buying puts has you pay, and therefore it's a debit. So how do we call the debit spread that makes you bearish? Bear put, right? And then the opposite is true. Okay, so if the bull call is the debit, then the bull put, change call, make it put, it's gonna be the credit. If the bear put, it's the debit, then the bear call, it's gonna be the credit. Again, everybody has a different way to think, and maybe some of you may feel like, oh, I just want to memorize this. Some of you, oh, I just want to make a note next to my keyboard. Some of you, you just got it and that's it. It's embedded in your mind. Everybody has a different way on how to think, but again, it's only 4 cases. So even though it's a little confusing if I read it fast, please don't allow yourself to be overwhelmed by this. It's quite simple. We just need practice, like everything else in life, and then we're fine, okay? So again, we got the debit spreads, we got the credit spreads. 2 are bullish, 2 are bearish, but remember, the credit not only are bullish and bearish, they are also neutral. Because, okay, that neutral is another way to say non-directional. Okay, so credit spreads can be directional or non-directional, so you are bullish or neutral. Okay, or if you do the call spread, bear call spreads can be directional or non-directional, or another way to say that is bearish or neutral. Okay, so the neutral thing means non-directional, and non-directional means what you care the most about is not the direction of the stock. What you care the most about is time passing, reaching that magic expiration date. Like the trade with Tesla, where options were sold. I mean, if you think about, look at the bottom part, guys. Okay, so please focus on the bottom part of the screen here. Okay, just focus on sell a put and buy a put. Okay, well, what is this? Well, sell a put and buy a put is a bull put spread, right? So basically what we said is that particular day, which was the day when the trade was taken, right there, okay? That day, which is the day when the trade was taken, we said, hey, wait a minute. I am expecting that stock to not to reach this place on the chart anytime soon, which is below the UFO. So what did we do? We did a bear put spread, okay? Bull put spread. And why did we do that? Well, because if from here it goes up, the puts will expire worthless. Remember, puts gain money when the market goes down. That's how the puts gain value. But remember, you are selling them, so you don't want them to gain value. You want them to lose value. So how are those puts going to lose value? They will either lose value because the stock moved up, or they will lose value because time will pass, right? So what was the bet? The bet was, I don't think it's going to come below the UFO anytime soon. So let's sell an option that expires in 2 days. That was the case. It was a 2-day expiration option. Let's sell options that expire in 2 days. So if those options expire, if that stock doesn't reach this place on the chart in 2 days time, those options will expire with no value. So whatever I got paid for them will be kept as a profit for me. Okay. So what were you doing? You were bullish. Okay, you were planning on the stock to go up from there, but remember, you are also neutral, meaning that you could afford the stock to go down, to go up, to go down, to do whatever kind of sideways motion, and even go against you for a bit. But as long as it doesn't reach this price, 257.5, which was below the UFO, right? As long as you don't reach that level, what's going to happen to the options? They would expire worthless on that expiration date. So that's why we did a bull put on Thursday. But what else did we do? Well, apart from doing the bull put, we also did the bull call above, right? Because take a look. Above, we sold a call, and below the call we sold, we bought a call. This is known as a bear call spread. All right, here we go. You sold a call and you bought a call. Okay, so that's a bear call spread. And what happens with that? Well, it's the mirror image. So let me explain it on the chart. So this was the day when the trade was taken, right there, the blue circle. This was the expectation for us, where we didn't expect that stock to reach this place on the chart anytime soon. Why? Because we had UFOs to defend ourselves. So what did we do? Okay, what did we do? Well, we sold a call and we purchased a call. In other words, we collected a credit. And what needs to happen for this credit to become zero? Well, it's either that stock goes down, because remember, it's called a bear call spread. Why is it called a bear call spread? Well, because it's a credit, and when you sell options, you want them to become zero. How am I going to see those options lose value? Two things could happen for those options, those calls, to lose value, because they're calls. Earlier they were puts, but now they are calls. So what needs to happen for the calls to lose value? Well, one thing that would impact the value of the calls going down is the value of the stock going down. If the stock goes down, the calls go down, right? Calls follow the price of the stock. But what is the other thing that would make the calls to lose value? Time passing. Why? Those calls would become zero on Friday, right? The trade was taken on Thursday. Okay, that the vertical line represents Thursday. The last candle on the chart represents Friday. So on Friday, those calls became zero. Okay, so what do you do? What do you need to happen? What you need to happen is that before Friday, it's either that stock doesn't reach the circle above, or the stock goes down. Even if the stock goes up, and starts doing something, cute and fancy here on the top, but doesn't reach above 280, what's going to happen? Those options will expire. Why? Because it's Friday expiration. Okay, so what will you do? You would have collected another credit from the call side, the side above, and those options would have expired too. So the bull put, it's what we have below. The bear call is what we have above. And if you do it together at the same time, magic, please don't be impressed, because it sounds very fancy, but it's very simple. If you do it together, the bull put and the bear call, it's called an iron condor. Okay, and many people that never traded options before are gonna think, oh my God, that sounds like a very complicated thing. Well, not necessarily. If you never traded options before and you don't know what options are, yes, let's face it, it sounds very fancy. Especially if you do variations, you can do things called, broken wing iron condors, broken wing iron butterflies. So, it sounds super fancy, but the reality is that beyond the fanciness of the terminology, there is a very simple option application, which is you do a spread below and you do a spread above, and that's it. That's your iron condor. The bottom line is, what are you doing? You collected premium not once but twice. You collected credits not one but twice. Why? Because you did the bull put below and the bear call above. So you collected 2 credits instead of 1. And what do you now need to happen? You need time to pass from Thursday to Friday. And you need price to remain between UFOs without surpassing above or below the UFOs. You just need price to remain between UFOs, which is likely. And what happens? Well, now you made a profit just because options expired and you were paid a credit when you sold them before expiration. Is that simple? Okay. So again, credit strategies. Okay, credit strategies. Spreads in this case. Would be a strategy. Here we go. So credit spreads would be a strategy where basically what you're doing is betting on being bullish or neutral, or betting on being bearish or neutral. But if instead of doing credit spreads, what you do is, for example, an iron condor, okay, which an iron condor is simply a bull put spread plus a bear call spread combined. Yeah, now it's not a spread anymore, because now this is using 4 units. This is 4 options at a time instead of 2. Okay, so it's technically speaking, it's not a spread anymore, it could be called a complex spread, but it's not a spread the way we have defined it up to this point. But really, you can always break it down into 2 pieces. It's not that complicated to understand, especially after you have taken a few trades. Okay, so anyway, this is the kind of like the tour I wanted to give you when it comes to understanding credit spreads and other possible variations at this point. So this is what is a credit spread. What I want to do now is to get into the how. Okay, so how do we build those trades? How do we deal with this? And we're gonna plan on all those trades, okay? But before, I would like to confirm with you all guys that you guys are okay, that it's all good on your side, that everybody's following, that you don't have any question, because if you do, this would be your time to type, so I can give you a proper answer. So go ahead, please, and if there is anything for you to consult or confirm, please let me know. And if you have nothing to say, just say yes or hello or yes or everything good or whatever, just so I know you are alive and you are with me. Very good. Thank you for that, John. Yeah, also Max, thanks. Mario, fantastic. Good. So Mario, very good question. Okay, Mario is asking the question about the risk. Okay, good. So I'm gonna get a little bit into the how to build a credit spread in order to be able to answer your question, Mario. And I want to get deep into the how, okay? But right now, just let's very softly talk about the how do we build a credit spread, just for the purpose of understanding the risk associated with this strategy, okay? Because remember, when we do debit spreads, okay, you are a net payer. So let's say your debit spread cost you $300. Well, we said that the other week, isn't it? Even if you tell me, Jose, I'm not going to use stops, right? I'm not going to use stops at all. Forget about stops. I don't care about stops. Would that be wrong? Well, no, It all depends on your trading plan. But why did I say no? Well, because if you paid $300 for a debit spread, so then think about it. What's the most you can lose? It's $300. There is no way you can lose more than the amount of money you paid. And because the debit spread is called debit because you pay, then whatever amount of money you paid is the risk. But what about the credit spread, which is Mario's question? Okay, very, very good question. So what is the risk associated to a credit spread? Well, in a credit spread, you get paid. Okay, so the good news is that out of the bed, you collect some money, and that money is going to be either a profit or it's going to be some amount of money that allows you to reduce the risk. Okay, but even though credit spreads are great, there is no free money in the marketplace, correct? So there should be somehow some risk associated, right? So now, think about the spreads that we have on the screen here. Here we got a spread where you are selling the 257.5 put and you are buying the 255. And then above we got an option where you buy the 280. You sell the 280 and then you buy the 282.5. So what's the risk in those particular spreads? And to understand the risk properly, it would be useful to go to page 1 of our notes. So let's go all the way to page 1 of our notes and remember what is the situation when you buy a call, for instance, and what is the situation when you sell a call, for instance. Well, when you buy a call, you obtain the right to buy an asset. Okay, well, in this case, you were buying a call, which is a 280. So you have the right, okay, you have the right to buy at 280. That's your right, right? Actually, I'm doing this wrong. Sorry for that. It's 282.5, not 280. I was just copying this in the wrong place. So 282.5, that's your right. Okay, so if you buy the 282.5 call, you acquire the right to buy that stock at that price. But while you do that, you have sold the 280 call. And when you sell the 280 call, you are obliged to sell that stock at 280. So you have, if you do the spread, the credit spread, you have acquired the obligation to sell the stock at 280, right? Remember, as long as the stock, remains doing whatever it's doing, up and down, whatever the stock is doing, up and down, it doesn't really matter. Whatever the stock does, you don't care. As long as the stock remains below 280 prior to the expiration date, those options will expire with no value because the right to buy at 280 is worth nothing if the price of the stock is 275. So those options, those calls will become worthless, and therefore, if you sold this one, for example, this one, let's say you sold it at 5, and the one above, let's say you bought it at 3, right? 3. So you got paid 5, you paid 3, you have a credit, okay? The credit equals 2. So what's gonna happen if the stock remains below, you make 2. That's it. So what is the risk? Where the risk happens, okay? The risk happens when instead of having the stock instead of having the stock to remain below the 280, the risk takes place when the stock goes above. Okay, so let's say for this example, let's say the stock goes up to 295. So what's your risk in a scenario like that? Well, wait a minute. If the stock goes up to 295, your 280 call will become in the money. In the money. Because even if we reach the expiration date, the 280 call has $15 of value built in. $15.15 is the difference between 295 and 280. Right? Why is it? Because the stock went up to 295. So that option's got intrinsic value. It's what is known as an in-the-money option. And therefore, if you sold it, you will be, okay, you have an obligation to fulfill, and therefore you will be what is technically known as assigned. You will be assigned, and therefore you will have to fulfill your obligation, which is to sell 100 shares of stock at 280, if that's the case. Now, if you don't have the stock, which is the case when you do a spread. Normally you don't have the stock. So if you are obliged to sell a stock you don't own, what really happens? Well, you become short. You are short shares of that stock at 280. So that would be your situation. Okay, and then what? Well, if the stock goes down, it's good for you. But what if the stock goes up? And in this case, it went up to 295. Well, if you are short shares at 280 and the stock went up all the way to 295, initially you would be thinking, the size of my loss is $15, which is the intrinsic value built in the option. Okay? And that's 100% true and correct when it comes to the 280 call. But what happened? You didn't sell the call on its own. This is what is known in options trading as naked options, okay, or naked selling of options. So if you had sold a naked call, then you would have accumulated $15 of loss. Why? Because you were obliged to sell at 280, the stock is 295, so you suffered $15 move against you, so you are losing 15 times 100. But the fact is that you are not naked. Not naked means that you bought an option against the option you sold. And that one is giving you the right to buy at 282.5. In other words, you're paying, okay, no matter how high that stock will go, above 282.5, you don't care. You don't care because you have the right to buy and therefore exit your short, isn't it? When you are short, okay, if you short a stock at 280 and you want to close the trade, what do? Buy to cover, right? So buy to cover is buy. So you are short at 280, you buy to cover at 282.5. So how much is the amount of money you lost? 2.5. So what is the risk of the credit spread? What is the most you can lose no matter how far a stock goes against you? It doesn't matter how far a stock goes against you. The more you can lose when you do a credit spread is the distance between strikes. How much is the distance between strikes? 2.5. That's the most you can lose. But wait a minute, it gets better. Why? Because for you to assume the risk of losing 2.5, okay? So strike difference is 2.5. So for you to assume this risk of 2.5, you have got paid a credit. Correct? So let's say your credit is whatever. Let's say your credit is 1. So if your credit is 1, so you get paid 1 to take a risk of 2.5. So what is your total net risk? Okay, well, your risk is 1.5. So the long answer to your question, Mario, is that the risk when doing credit spreads is the distance between strikes minus the credit received. That is the most you can lose. If you close your eyes, if you didn't use stops, if you didn't do anything, that's the most you can lose. Okay, good. So I think I hope I answer your question there. A few more questions in the comments box. Let me take a look at that. Let me see. David Hyde, how are you, my friend? A vertical above current price, a vertical below current price equals iron condor. Simple. Exactly. That's what it is. Many people, think about it like, even in some books, you will see iron condors in a section in the book that typically is known as complex spreads, right? So it's kind of like they try to make the book interesting by having a complex section. Guys, trading should be simple, okay? So, and yes, I understand that 4 units is not as simple as 1, but if you break it down, it's not 4, it's 2 of 2, right? And that's it. So it's not that complex. Max, so you need a stop in credit spreads? You don't. You could certainly use stops in every strategy you use to mitigate your risk even further. But as I said, if you were to close your eyes, what is the most you can lose is the difference between strikes minus the credit received. That's it. Okay? So how are we going to build spreads? Okay? How are we going to build credit spreads and debit spreads? Okay? Well, guys, we're going to follow very, very similar rules that we had before. But of course, you heard me say many times, credit spreads is like the mirror image of debit spreads. Well, guess what? Be ready, because many of the rules that we had here for option spreads will not be exactly the same for the credit spreads, okay? They will not be the same exactly. We talked about rules when buying puts, for example, right? We talked about options decay. That's a problem. Wait a minute. In credit spreads, options decay is not a problem. It's what you're shooting for. The trade that we took on Tesla on last Thursday was a 2-day trade. So we used a 2-day expiration option. You guys with me on that? So obviously it's the mirror image, okay? What is a problem for debit, it's an advantage for credit. And what is an advantage for credit is a disadvantage for debit, okay? So the rules that we're gonna be using are quite different, okay? It's gonna be all common sense, it's gonna be very simple to understand, but it's gonna be, again, the mirror image, okay? So that's why I spend a lot of time giving you explanations about giving you a little bit of insight of what those strategies are all about. So now when we spend time doing the how, it's gonna be quick, okay? Because you understand the nature of those strategies, and therefore now I need to show you how to build them, okay? So think about it. Talking about mirror image, debit means you pay, right? Debit means you pay. And what does that mean? It means that you want to pay cheap. And how do you find cheap? Well, for you to find cheap, you need to look at the cheapest options in the market. And how do you do that? We use the scanner, right? And when you're looking at the scanner, what type of parameters do we use? Let me show you. Well, in here, you can see that the bottom, the parameter is set as bottom 50. What does that mean? That we are looking at, at stocks that meet a series of conditions, but the ones that we are picking are the 50 stocks with the cheapest options price out there. And then we apply the conditions on those stocks only. No wonder, like for example, we only had one stock to meet our condition. Okay, why? Because we are very picky. Okay, because when buying options, remember the decay, and the most you can lose is what you pay for the debit. So you want that to be very low, and therefore we were using this filtering system, this scanner, to do that. So look at what I'm gonna do here. I'm gonna do it, in front of you, so you guys can replicate that for yourself. So I am renaming the scan. Okay, I'm gonna use the same name. So directional long, and what I'm gonna do is at the end, I'm just gonna add D for debit. In other words, this is what I do when I'm looking for debit spreads. Okay? This is what I do when I'm looking for debit spreads. But what if I want to look for those debit spreads where I am directionally bullish, but as you know, credit spreads are also neutral. So I am directional and non-directional at the same time. So I am selling options. Okay, what if I want to have a little bit of a bullish bias? Okay, a little bit of a bullish bias, but I want to do it in this context where I'm going to be selling options. Well, what I'm going to do is right-click and copy the scan. So I just made a copy and paste the scan. Okay, yes. So I just made a copy of it. So I got 2 directionally long D. And what I'm going to do is I'm going to rename it. Okay, and instead of directionally long and D, right, which is what I had before, what I'm going to do is I'm going to use the term neutral long, and therefore it's going to be credit. Okay, so I'm going to go for neutral trades, which are credits. Okay, and here is a new item on my list. Of course, it's not enough to have a new item on my list. I need to format the scan, and out of all the parameters that we put together before in prior sessions, I'm going to change bottom, and I'm going to reverse this to top. Okay, I'm going to change it from bottom to top. But not only that, okay, I will also be accepting stocks where the ADX, okay, the ADX, you know, basically I will not care about the ADX. In other words, when looking for directionally long trades, okay, which was the case that we have here with the D, right, directionally long. Remember, if I do a debit, I need the stock to move for me to get paid. So we were using a parameter of ADX of 25. Why? Because 25 ADX means you are dealing with a trending market. But remember, now I'm neutral. I have a little bias to the long side. Okay, I have a little bias to the long side. So, you know, I'm okay with having the stock in an uptrend, and that's why I'm going to be using moving averages to filter those stocks in an uptrend. But I don't necessarily need the trend to be a strong trend, which is what ADX greater than 25 means. I don't care if the trend is strong or not because I'm actually neutral. I am slightly bullish, but I'm neutral because I make money as time passes. This is really how I make money. Time has to pass. So I'm going to delete the ADX item from my scanner and click OK. And now I'm just going to run a filter. I'm just going to run a scan on this neutral long. You know, and this is going to find for us opportunities. So we're going to be building. And here's a quiz question for you guys. Everybody ready to answer this quiz question on the comments box. If I am neutrally long, question, what type of option strategy will I be using? Will I be using a bull put spread, a bull call spread, a bear put spread, or a bear call spread? Please type it on the comments box, just for fun, while we're waiting for the scan to finish his process. You guys, tell me please go ahead and type it. So that way, give me a confirmation as well that is all good. Max has a question as well. So in a spread, if it goes against you, you could always lose the difference. Yes, the difference between the strikes. You're right. The difference between the strikes minus the credit you collected. So if the difference between the strikes is $2 and you collected 50 cents, your total risk is 2 minus 50 cents equal $1.5 is the most you could lose. Okay. Very good, guys. I can see those answers kicking in and very good answers. Wonderful. Yeah. Yeah, I can see as well, out of all the people that we are connected, I guess that some of you are a little bit or either on the shy side or either on your phone answering messages. Okay, so I would need your focus here with me back, guys. Okay, and as I said in the last session, I believe it was, let's work together as a team here, guys. Okay, I need you to be engaged if that's okay for me to ask. Okay, so we have the directionally long. I'm gonna go ahead and rename the short as well. So we're gonna do the same thing. So directional short and D. So that's gonna be our debit scan, right? And then what I'm gonna do for that debit scan, I'm just gonna copy the scan. I'm gonna paste the scan. Okay, here we go. So here's the scan, and now I'm gonna edit, rename it as well, and we're gonna call it neutral short and C for credit. Okay, so I got my neutral short, C for credit. I'm gonna right click, format the scan, and again, same as before, we will change the bottom to be the top. And the ADX, we don't care about the ADX. So I'm going to get rid of the ADX and I'm going to click OK. And my scan here is ready. Okay. So still running on the long. We'll have the short, but notice how cool this is becoming, guys. Again, Forex and futures, I cannot wait to get into that with you guys as well, which we will. But for now that we have been spending time with the options, okay, little by little, it took a while, okay, because of course there are many things for us to discuss. But little by little, we've been building scans here to make your life simpler, right? So if you want to be a debit trader and you want to make money catching moves and riding moves, you can be directionally long, directionally short. If you are less concerned about timing the markets and you want to relax yourself a little bit, because timing the markets means wait for the price to come to your price, get the entry, have a stop, has a target, all these things. So, well, if you want to be a little more relaxed and just sell options and wait, knowing that you could be wrong, and of course your risk will be under control, but now instead of making money out of moves, you want to make money out of having time pass. Okay, so you could certainly go for you know, for those new scans we just built, neutral long, neutral short. And then, you know, the last one in the bottom, you know, we'll review that as well. The non-directional, that's the one we used on Thursday when we picked Tesla out of the list, okay? Because that's a scan that will be for purely non-directional trades where you are not bullish, you are not bearish, or another way to say that is that you are bullish and bearish at the same time. So you do the bull put and the bear call at the same time, so you do iron condors. Okay, so notice how cool this is now. We're getting organized here, and hopefully this is helping to make your life simpler and find better trades as well. Okay, and then of course the beautiful UFOs, the cute UFOs on the right waiting for us. Okay, so anyway, the scan is still running. I'm gonna have to wait until the scan is finished. You know what? For whatever reason, I want to confirm. Let me format. Well, I cannot format the scan because it's running. Yeah, I just want to double check I did it right when I did the neutral long. I think so, but just want to confirm that. So I'll have to wait until the scan is over, okay? So we're just gonna wait. So let me see. Max, how do you choose the prices? Okay, very good. So this is exactly what I'm about to explain, Max, okay? You are basically asking me, so how do you build a spread? How do you pick the strikes? How do you pick the expiration date? We are going to do this together. I just need to wait for the scan to finish, because that way I will explain it using real cases, real examples, instead of a made up theoretical explanation. You guys received the theoretical explanation before when I was using my Word document. So now it's time to do it in the real world. So I'll do it with the scan. John Clifford as well has a question. Can you tell me which session you did the previous scans on? If you recall, I must have missed it. So to be honest, I don't remember exactly which one. What I will point at, okay, is the following. If you were to click, not here, if you were to click Get Together on our website, and you scroll down, okay, you get here to the YouTube sessions, right? So this is our playlist, and when you click on the playlist here, I would guess that most of you have seen this before, but just in case. Okay, just in case. So when you look at the playlist, you can see all the videos are sorted. Okay, so you can see the sharpening here, sharpening number 6, sharpening number 5, etc., etc. So you have all those videos here, and you can go back in time and consult. Okay, so something that I will do to make your life simpler as well, because of course if I cannot provide an answer to your question, which is which session I did it, and you happen to not to watch it, or you're watching this recorded, really I'm asking a lot from you to go back and rewatch the whole thing, because it's many hours. So what I'll do at some point is I'll take nice screenshots of all the scans, and you know, somehow I'll find a way to share that with you guys, so that way you can have a nice screenshot. Okay. Oh, Gabrielle, this is very, very nice of you. Thanks for that. You guys are amazing. You guys are tracking what we're doing in a more accurate way than ourselves. So super appreciated, guys. You see that makes my day. You know, when I talk about teamwork and being engaged and all that stuff, I love it, guys. Okay, trading, the last thing you want to do as a trader is to be isolated. Okay, so you know, you guys should be connecting with each other, connecting with us, us connecting with you. Everybody is part of the same team. Okay. By the way, talking about the same team, since I'm talking about this super fast, you know what? Let me do one thing first. So I want to take a look at the scan, because the scan just completed. So I want to take a look up with 9 stocks that may meet our criteria. So we're gonna take a look at those, and we're gonna talk about how to build those trades. Okay, but the comment I was going to make while we wait for the other scan to also finish his process is that when you look at our YouTube page, you know, it transpires out of conversation. There will be times where we upload certain videos. There will be times, you know, where we may even share trades or stuff like that in the YouTube channel. We haven't done that yet, but you know, we will. And you know, you will be notified real time when all of this happens. So make sure, you know, you subscribe, you know, so we can get you in a communication system a little more efficient than us. Okay, because we'll send emails and all of these. Build a credit spread. So what do we need to do? Okay, well, the first step is check the earnings calendar. That's the first step. And if you have been with us in the get-together sessions that we do on the Thursdays, you have seen us do this all the time by using a website called, let me show it to you here, a website called briefing.com. Okay. Again, there are many websites that talk about earnings reports. My experience has me see this website as a website that normally has quite accurate information in it. I've seen many times the case, I believe one of you the other day was saying that in earnings.com there was an earnings report date that was not right. So I've seen that in other websites often, but I have not seen it often in briefing.com. So again, maybe one day I'll be wrong on that one, but out of years of using this website, I think it's quite accurate. Okay, so that would be my little recommendation here. Even though if you prefer another website, feel free to use it, or also feel free to share on the comments box. Again, as I said, we are a team here. Okay, so feel free to share. But the first thing that you will want to do, for example, Caterpillar, CAT, is the first stock on the list. The first thing that you will want to do is to enter that stock symbol so we can go ahead and assess when is the next expiration date. Why is this important? Why is this important? Well, this is not only important, it's critical. That's why I have it as step one. Because what happens is that we are scanning. You may remember a minute ago when I constructed the scan, I selected top 50. Meaning that we are looking for the 50 stocks in the market with the most expensive options available as we speak. So what does that mean? Well, that means that options are very pricey. And what could be a reason for options to be pricey? Well, options are pricey only for one reason, which is that many people buy them. Okay, if many people buy options, they gain value. If many people sell options, they lose value. So if options are pricey, it's because many people buy them. And what is a classical reason why people buy options? The earnings reports that happen once every 3 months. So I can show you this, very, very clearly here. Let me load Caterpillar in a daily time frame. And I will add a couple of things here. So let me add implied volatility first. Okay, implied volatility first, and then let me add an analysis technique, which is, which is a show me, looking for EPS postings. EPS stands for earnings per share. In other words, this indicator will show on the screen with dots, the time when earnings were reported. Okay, let me make it beautiful magenta color. Okay, so. Well, actually, it took it as yellow. So take a look. This yellow dot is the day when earnings were reported. And the one before was the prior earnings 3 months before. And the ones before was the day earnings was reported 3 months before. So notice what happens all the time prior to earnings. Notice what happens all the time prior to earnings. Options become quite pricey. Okay? Options become quite pricey. Why? Because everybody buy them. Why? Because people gamble. People will buy options like, okay, hopefully the earnings are going to be so good, this company is going to move, 20% up. So what do? They start buying options like crazy, hoping it's going to go up and knowing that if it doesn't go up, the most you will lose is what they pay for the option. So it's a smart gamble, but it's a huge gamble because when people keep buying and buying options, they become very inflated. So if the price of the option got an expected move built in of 20 and then the move is 15, so even though the stock moved $15 after the earnings report and you were right when you bought the option and the stock moved your way by 15, well, the reality is that you lost money because the option you bought got $20 of move built in, and because the stock only moved 15, actually, even though you saw the stock move your way, you actually ended up losing some money on the trade. Okay, why? Because you bought a super overpriced option. Why? Because of the earnings reports. So what do we want to do? We want to sell options to those gamblers. That's what we want to do. That's going to put us in a high probability situation. Okay. Now, of course, you don't want to do it just because they are gamblers. because the earnings report could have power and could have an impact. You want to do it as long as the UFOs tell you that you have something to defend yourself, and you sell options that are very overpriced to people that buy on hope, and time passing will produce a benefit for you. Is that making sense? But in any case, doing it around earnings is never a very good idea, because take a look, for example, here with Caterpillar, when that earnings was reported, okay, around that date, okay, we saw a movement on the stock, which if I was to measure that gap, this is like 8% gap. Okay, so what happens? Okay, well, earnings reports could be a reason, not always, but earnings reports could be a reason for orders to be canceled. So you have on-field orders, which are identified by the beautiful UFO, and they are there, but now because of the earnings report, the orders could be canceled, and then you have an 8% gap, and then you get in trouble. So even though the UFOs would be a nice way on how to defend yourself, going through earnings, relying 100% on the UFOs may not be the smartest approach, because again, institutions, the big banks, the big players, they may cancel, those on-field orders in the marketplace. So the reason why step one is to check the earnings reports is to make sure that those options are very high price, but there is no reason for it. Okay. In other words, just people are getting into some sort of a cycle. Okay. Let me show you that again. If I show you the price of the options and the earnings report again, take a look how here, for example, okay, that was the earning date. That was the earning date. Okay. So we talked about how options inflate right before, right? But what about here? So why are your options here inflated? Okay, why are the options so expensive at that time? There is not a clear reason for it. Probably there is no reason. It's just the fact that, a cascade effect of people getting greedy, getting fearful, whatever that is. But there is not a real reason that may have Caterpillar to move 8% on earnings, or 10% or 20% or whatever, right? So this is the situation that we're looking for. So what the scanner will do for us, okay, the scanner up here, is to find situations where options are the top 50 when it comes to their price. So we are looking for options in this level of price, okay? But we need to manually double check with briefing.com that the earnings date is not too close from today. Because if that's the case, then, we are exposing ourselves to have a gap against us. And remember, when you sell options, it's a credit. When you do a credit, you need time to pass and have the stock to either move your way or stay the same. Remember, you're a bullish and neutral or bearish and neutral, but you don't want it to move against you 8%, 10% move, because then it's going to be painful. Okay. So we are looking for some weird situation that provides an extra statistical edge for us. In this case, we found no one. We found 9 situations that potentially are good, and certainly by looking at the earnings date for Caterpillar, April 24, not a problem with that, because today it's March 24, so you have 1 whole month. And by the way, this leads me into what will be a next step in a minute, which is use short-term expiration dates. Okay, the shorter, the better, but I need to add a but in a minute, right? But why did they say the shorter the better? Well, because remember, when you sell options, you make money the day they expire. And the shorter the expiration date, the sooner that's going to happen. Okay, and by the way, many people believe that because the shorter the expiration date, the less the premium. I mean, let me load an option chain on Caterpillar. Okay, so 1 sec here. Because many people believe that the less the expiration date, the less the premium, many people kind of like to sell long-term expiration dates instead of short-term expiration dates. And that's not the way to do it, guys. You'll see why in a minute. Okay, so loading Caterpillar. Okay, almost there. Here's the option chain. And again, for example, let's say we are looking at March 19 and we are looking at the 130. Okay, if we look at the call, it's 198. If instead of March 29, you look at April 5, the 130 is 278. So most people would say, okay, 278, it's more than 198. So you know what? Let's go ahead and sell the 130 because 278 is more than 198. Well, it's not exactly like that. Because if you were to think about how much premium you got per day, okay, let's do the math. Okay, so 5 times, which is 5 days, 198 divided by 5, this is paying you at a rate of 40 cents a day. Well, if you do 2.78 divided by 12, which is April 5, 12 days, that is paying you at a rate of 23. In other words, the one that is the front week, actually is a quarterly option, so March 29, I'm not sure that's going to be Friday. When is nice? Yeah, actually, yes, it's Friday. So, this quarterly option, okay, which is also weekly, it's both quarterly and weekly, pays you almost double per day than what April 5 pays you, even though, yes, of course, 278 is more money, but 198 is more efficient, okay? Plus, you remove the risk of the trade in 5 days instead of 12 days, because 5 days later, the trade is over. Okay, so when doing credit spreads, when doing credit strategies, you always want to use the shorter expiration, the better. Having said that, if your UFOs are far away, things like that, you may get paid very little. There may be times where, let's be extreme for a minute here so you understand my point. So maybe I'm looking at, the 137 and it pays me 15 using the front week, and you're gonna be like, oh, 15 is not enough. Where if I look at the 137, well, now you get paid 50. So now what would you do? Well, you would need to go for the one with 12 days, which is April 5. Why? Because the UFO was at 137, and if the UFO is at 137, well, being paid 50 is okay, but being paid 15 is not. And because we cannot change that, then you will need to go and decide to use April 5 instead of, March 29. And it's just because of how far the UFO was. But as long as you could use the shorter expiration date because the UFOs were close enough, you would want to use the shorter expiration date, right? And certainly, make sure that expiration date happens prior to earnings. Okay, make sure the expiration date happens prior to earnings. So step 1 is check the earnings calendar. Step 2, use short-term expiration dates. Okay. Imperative. It has to expire before the earnings date. And then the shorter the better, okay? And then there is a but that we'll discuss later, okay? So let's take a look at Caterpillar, okay? And let's say we're gonna use a 60-minute time frame with Caterpillar. Let me take a look at your questions while this is loading, guys. Let me see. Junebug, so you say institutions do cancel orders. Is that true in Forex, stocks, and futures? Yes, absolutely. If that was not the case, the AutoUFOs tool would give you 100% winning trades. Okay? So sometimes institutions will take their money out of a market to put it in a different market, and therefore they could cancel orders. Absolutely. It's not going to be that common, but it will happen. Mario, also the perception of a market turmoil can make option more expensive in general. Yes, and again, the turmoil, will take place going from UFO to UFO, isn't it? So you could certainly position yourself in a smart way to take advantage of that. Okay. So what do we have? Okay, what do we have? Well, if I load that Caterpillar here, okay, and you look at where the current price of that particular stock is here. Now remember. Let let me redraw this because I just hit on the wrong button. This is the current price of Caterpillar right there. Okay, this is where the price is, 129.78. Now remember, we are looking at the scan that was looking for long trades. In other words, even though you know, this stock is kind of like in the middle of nowhere, and you see you got multiple UFOs above and you have multiple UFOs below, and you could actually say, and you know, it could make sense that when it goes up and hits the red UFOs, that stock may fall, or when it goes down and hit the green UFO, that stock may go up. The fact is that because of the parameters of the scan, that stock is more likely to move up than likely to move down, right? Even though I'm okay to be neutral because this is a neutral scan, but because of the moving averages that took place in the daily time frame that are on the scan, the 21 and the 34 moving averages still pointing up, and therefore that stock is in an uptrend in the larger time frames, and therefore those green UFOs are likely to produce a better effect than the red UFOs. So in this case, you would want to position yourself as being neutrally long, or you know, non-directionally bullish or directionally bullish, or you name it, right? And therefore the idea would be to construct a bull put spread. And how are we going to do that? Well, you will need to sell a put and buy a put, okay? And where are those puts going to be set? Well, that's where the UFOs come into play. The puts should be located below the green, okay? Sell a put here and buy a put below the put sold. Okay, that's how you're gonna build a bull put spread. Now let's talk about the first one. Why are you selling a put there? Let's call it 120. Okay, actually 121 would do it. Okay, so why would you want to sell the 121 put? Well, you would want to sell the 121 put because, in other words, you will want to sell the 121 and you will not want to sell the 129, for example. So selling the 129 put versus selling the 121 put, okay? So what's the difference? Well, the 121 put is below the green. The 129 put is above the green. Now remember, this is a neutral long position. You are neutrally bullish, but you are bullish. So you need this thing to go up or stay the same. Okay? It needs to go up or stay the same. So what's the problem of the 129? The 129 is that you got no UFO at 129. So it may not stay the same. It may go down. And therefore you start losing. Where if I sell the 121, I got multiple benefits of using the 121 instead of the 129. Why? Well, first of all, it's not likely for this market to reach 121. Why? Because I got 1, 2, 3, 4 green UFOs to defend myself. So as that market goes down, those UFOs are likely to push Caterpillar back up. Or if any, at least make it trade in a range or something like that, and therefore allow for time to pass, getting closer to the expiration date, ideally getting all the way to the expiration date. Or if I do the 129, it's kind of a gamble. Price is in the middle of nowhere. I got no UFO to defend myself, and if it goes up, lucky me, and if it doesn't go down, if it doesn't go up and goes down instead, then I'm gonna lose. So the 129 would be a little bit of a hopeful approach to doing the bull put spread. So the very safe approach would be to sell the 121 put, because that one is a put that is not likely to be a sign. Okay, price is more likely to remain above 121 than go below. Okay, and then what you will want to do is to buy a put below the put you sold. So that would be, let's call it the 120. And if you were to do that, you would now collect a credit, okay, which is going to be the difference between those two guys. Take a look. Take a look at this. And I have a question here from Gabriel. So let me take a look at your question, Gabriel. So Jose, not sure if you have mentioned this. Have you mentioned any objective rule when the premium is too little, so it's not worth to take the trade? I haven't. and we're gonna draw the line at 25 cents. Normally, when an option is selling for less than 25, it's basically wasted time. Okay, so we would want a minimum of 25 cents. And by the way, most of the time, this is not even gonna be enough. So, you know, you will see me shoot always for at least 35 or above. Even though if you were to take 25, I would say is the bare minimum and it's not crazy, but more than that would be desirable. So take a look at March 29, because remember we said the shorter the expiration date, the better. So if I look at the 129, how much I get paid? Well, I will get paid anywhere between 20 and 45. Okay, 20 to 45. This is the amount of money you get paid. Now, again, the market is closed now, so the spreads widen as the market closes. So just to have a little bit of an estimation, I'm gonna look for the midpoint between 20 and 45, and that is 32 cents. What did I just say? I said that you could take 25 cents, but normally you will see me shoot for 35. So what am I gonna do? I'm gonna pass on March 29. Again, the shorter the expiration, the better. But, do you guys remember the but? But sometimes we don't get premium enough, and we are forced to use the next expiration date. Okay, so what are you gonna do? Well, we have a minimum, okay, of 25. 35 is better. Okay, therefore March 29 would not meet our criteria, and therefore now you understand what I meant by we have a bot, okay, on that prior statement. So what I'm gonna do, well, I'm gonna look at April 5, still the 129, and now I get paid 51 cents. Okay, the midpoint between 51 and 59 is whatever. Let's call it 51 out of simplicity. So I'm gonna get paid 51 cents. So now we're talking. Now, if I sell this one for 51, and the one I buy is the 120, and I have to pay 50, so my credit is 1 cent. Okay, so that's a problem. Okay, that's a problem. It's not enough. Okay, it's really, really not enough. Now, again, we are dealing with the option chain after the market is closed. If I was to go for the midpoint to have something a little more realistic, so 51 to 59 divided by 2, that's 55. 55 for the one that you sell, and 41 and 50, which is the 120 that you would buy, divided by 2 is 45.5. So if you pay 45 and you sell at 55, you have a credit of 10 cents. Okay, so this is not going to work either. So what is the next rule that you're gonna have? Okay. Concerning the protective strike in the example that we are running is the 120. Okay, so this is the option that gives you the risk. This is the option that protects you, and thanks to that option, the maximum risk you have is the distance between both. Okay, so we call the below option the protective option. Okay, the protective strike, which in the prior case was 120. So what we're gonna do is that concerning a protective strike, it needs to produce a credit which is at least 15% of the difference between strikes. What does that mean? Well, it means that if I do 121 minus 120, that is 1. And 1 times 15% equals 15 cents. Correct? Well, in the example we just did, we collected 10 cents of credit, which is less than 15. So what do we need to do? Well, I need to widen my strike. If this rule is not met, widen your strike. Widen your protective strike to one further away. So instead of doing 121, 120, we'll do 121, 119. Okay? And this is 2. And this times 15% needs to give us a credit of 30 cents minimum. So let's see if we have that. Okay? So what if I do 121 and 119? Well, 121 is going to pay us. Again, we said before, the midpoint between 51 and 59, that is 55. Okay? So I'm looking at the midpoint of 51 and 59. That's 55. Okay? That's the midpoint. So if I'm going to go for 129 and 119, and of course, I didn't say it before, but we are looking at the puts, okay? Because it's a bull put spread. Now I'm going to have to look at what's the midpoint for those two guys, 34 and 41. So let's do the math. 34 plus 41 divided by 2 is 37.5, right? So if I sell the 55 and I buy the protection and I pay 37.5, so how much am I going to left with? 17.5, which does not, does not meet our minimum 30 cents that we need to have. So what is this telling you? It's telling you that April 5, it's not enough premium for us to do the trade. So you will need to move into April 12, right? And now we are talking about 19 days to expiration, okay? But now, here's the concern. With 19 days, you know, we may be able to make it work, okay? We may be able to make it work, but here's my concern. Let me go back to the chart of Caterpillar. Let me make this line to be blue color so you see it very well. We'll make it exactly 121. Okay, so this is the 121 line. And let me move this to a daily time frame, just because in a daily time frame, every candle is 1 day. Right? So how much is the daily ATR of this thing? 2.37 days. 2.37 days. So if, as we assume when we do the TTE calculation, every ATR, right, it represents a 1 week move, and the option expires in 19 days, right? So 19 days divided by 7 is 2.7 weeks, is almost 3 weeks. At a rate of $2.37 net per week going down, that would imply $6.43. $6.43 minus the current price of the stock, which is 129.77, would bring this market to 123.33, which means that based on that ATR calculation, okay, that stock may does its things, okay, and 3 weeks from now, when the option expires, that stock may be trading around 123 if that estimation is correct. In other words, it looks like that based on what I just explained here, the 121 bull put spread is a very good trade because we have the UFOs to defend ourselves. 121 is far enough from the current price, and given the rate at which that stock is moving, it seems that you're not going to reach it until at least 3 weeks from now, and 3 weeks from now those options would have expired. So it's looking good. Okay, and by the way, if this uptrend, which is the origin of the filtering process, right? If this uptrend continues and that stock goes this way, well, obviously now you profit for sure. But I'm not concerned about it going up. I'm concerned about it going down, right? So it seems that even if it was going to go down, it's looking like you're gonna be okay. Okay. Now, it's not gonna be okay. Okay, it's not gonna be okay, and we're gonna have to add more tools to be able to assess all of this properly, because if you look at, for example, the speed at which the stock drops, when the stock drops, it's more of this type of a speed instead of that type of a speed. Okay, and therefore, I'm just using my visual impact here. Okay, I'm not using any calculation, but based on my experience and the visual impact, I would say that this trade is not going to be a trade that is going to be too likely to work well, and probably 121 is just a little bit too close, and therefore I'm not going to suggest to go for this trade. Okay, now ultimately we need to do a session, guys, a proper session on how to use this tool. And what's going to happen when this tool is that you have seen me use this, I think, once. But when we'll put a process in place, but with this tool you're going to be able to change dates and do certain simulations and use statistical calculations based on historical volatility and stuff like that to be able to calculate how long it's likely to take for that stock to reach 121, which are going to be way more precise calculations compared to the TTT calculation I just did. Okay, so we'll do that, because right now I just said that out of the visual impact and my experience as a trader, I would say this trade is not too high probability. But there will be times, okay, where we will find those trades that high probability, and we will double check this with the analytics tool to make sure it's not only an impression or a visual impact, it's actually a mathematical calculation that tells you if the trade is valid or not. Okay, so we'll certainly do that, but that's gonna be another day. Okay. So for now, I'm gonna have to ask you to bear with me. So next talk. So let's go for CSX to see if CSX is providing us with a valid trade. Just give me a second, guys, please. Okay, guys, I'm back with you. It's taking a little bit of time to load, so we'll be patient. But in any case, my prior comment, probably you guys are thinking about it. Make sure you understand something important here, guys. What's likely to happen for Caterpillar, based on the filtering process that we did, is that it goes up. Because it was in a green UFO in the daily time frame, there were 4 green UFOs below in the 60-minute time frame, and the overall trend was up. Is that making sense? So all of these together makes it an okay trade if you want to take it. But at the same time, what I will want to teach you is a much more picky process, where you're gonna run an extra process with the options analytic tools, where what we're gonna pretend is, okay, let's pretend it goes all the way against me. So if it goes all the way against me, so now what? What's gonna happen? Let's use mathematics and calculations done by the computer to, instead of conclude out of an impression that you feel it's good to take the trade or you feel it's not good to take the trade, we'll use mathematics to answer that question. And mathematics doesn't mean you need to do anything manually. It's gonna be done by your computer, okay? Good. So anyway, so let's look at that stock, and I'm just gonna be browsing through multiple stocks, again using a little bit of my experience here to save a little time, because I'm looking at the time. So let me see. Okay, I'll come back to this MDT. Okay, yes, it's still pending data. So I'm just gonna click on the symbols so data loads. Notice how out of our list we have a few symbols like XBI and also IBB. which both are actually ETFs that represent the biotechnology sector. Again, with ETFs, I remember commenting this in a session that we did before. With ETFs, the problem is that many times you get much little premium because ETFs by definition are a safe instrument, and therefore the amount of premium built in the ETF is always much less compared to stocks. So, the best trades that you will do, with credit spreads normally are going to be the trades that you do with stocks better than ETFs. Okay, so what do we have here? That could be, what about this one? Ideally you want to see multiple green UFOs and you want to see them closer to price. Okay, so this is looking pretty cool actually. 3 UFOs on top of each other, 51, current price is 54. Let's take a look at the option chain for DWDP. So, by the way, step 1 was not to look at the option chain. Step 1 was to look at the earnings date. So, DWDP. So, what do we have? Earnings date is May 2nd. Okay, so we got plenty of time with a month plus in front of us. So that's good. So what about 5 days from now? If I sell the 51.5, I get 24. So 5 days, I think it would be maybe a little too tight. But what about 12 days? So if I do 12 days and I do 51, so the 51 is going to pay me 38. Okay, 51 is going to pay me 38. So let's take a look. So if I do sell the 51, which is the midpoint between 38 and 44, which is 41, okay? So 41 is more than 35, so that's good, okay? So that's a good beginning. Let me write it down. So we are selling the 51 put, minus is for sell, 51 P for put, and then what if I buy the 50.5? Okay, so what if I do 51, 50.5? So if we do this, calculator please. Here we go. So we have 51 is 44 plus 38 divided by 2, that's 41. And if I do 50.5, that's 36 plus 31 divided by 2, that is 33. So 33 minus 41, that is 0.75. Okay, so 0.75 is what? Well, 0.75 is the net credit. Okay, 0.075 I should say, it's 7.5 cents. Now, what was the rule? Well, the rule was that you take the distance between the strikes, 51 minus 50.5, right? This is 0.5, and this you multiply times 15%, and that would actually be exactly 0.075. So if you want to do this trade, you could do it. I would not do it, and the reason why is because the problem one is, even though we meet the rules, but the problem is just a matter of convenience. When this is so little, it means that you're going to make $7.5 per spread. So if you want to make a nice profit, let's say you want to make $1,000, how many spreads do you need to sell? I mean, you need to sell. I mean, if every spread pays you $7.50 and you want to make $1,000 in the trade, you have to sell 133 spreads. It's completely nuts. Okay, so in a case like that, you would probably want to check, what if I do 51.50, even though it meets the rules, just to get a little more. So if you do 51 and 50, so 50 is 0.30 plus 0.24, the midpoint is 27. Okay, and by the way, I'm doing a lot of calculations here that I don't need to do. Let me add the midpoint so I don't have to calculate it. So midpoint, up. Here we go. So here's the midpoint. So you do 51 is 41, and you do 50 is 27, right? So if I do 41 and 27, so 41 minus 27, how much is that? That's 14. Okay, but now if you do 50 and 51, what is that telling you? It's $1 difference. You need 15, it's giving you 14. Again, it's borderline, borderline, borderline. Could you take this trade? Yes. Would I like to take it? No, because of what I said. So you would just keep going, guys, until you find a trade that works well. Normally, what would happen, because we're looking for something unique, which is an edge, right? We are looking for options to be very, very highly priced. We are looking for an uptrend. We are looking for the UFOs to not to be too far and many in a row to be well protected. We are looking for all those things. Earnings reports to be far away. So normally what happens when you look for those trades is that, you end up having a no-go, 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 no-go. And the moment you find a one that is a yes-go, then the trade is very high probability. Okay, so always be patient, guys. Okay, and go through the process until you find it. Okay, so MDT. So what happens with MDT? Okay, we got the setup. Okay, and here we got two UFOs on top of each other here on the 60. Okay. By the way, I haven't done it today, but I do it when we do live sessions. Normally, it's always good to look at pre and post market data. So notice how regular session gives you 49%, pre and post market data on that stock gives you 44. So because it's less, you're gonna ignore it, but sometimes it's more. So you have to keep it under consideration. Therefore, the way to do a bull put spread here would be to sell a put below, which is gonna be, I'm not sure if we have the 88.5. If not, we'll do the 88. So let's do 88 put, and then you will want to buy the 87 put. Sell one up below and buy one below the one you sold. So always the same. So back to the option chain. So we got MDT. So by the way, I didn't check the earnings date. That should be step one. MDT. It's May 23. Okay, so we are fine. No problem at all with MDT from an earnings date point of view. So March 29, what do we have? If I do the 88, it's going to pay me 23. Okay, well, it's not 25, it's not 35. Okay, so that expiration date doesn't work. What about the next one? 88 pays you 43. And again, huge distortion here with the prices. So if I look at the midpoint, it's 60. Okay, 60 and 34. Okay, that's gonna be $25. So here we go, we found one. Okay, this could be a trade that you could execute, because if I sell the 88 and I buy the 87, the 88 would pay me 60 cents and the 87 would have me pay 34. So how much the net credit collected would be? 60 minus 0.34. 34. You would collect a net credit of 26. But what's the minimum? Well, the minimum is 15, remember? Because it's, 88 minus 87 is 1. 1 times 15% is 15 cents. So you are shooting for 15 cents where you collected 26. So what would you do? You would certainly be happy to take the trade as long as you were to pass your probability calculation, which we need to cover another day to have an extra calculation to make sure the trade is not only good, but really good. For now, we can say the trade is valid, okay? But we want to go beyond valid. We want to go to very good, okay? And we'll learn how to do that. What if instead of doing the bull put, and by the way, I'm about to change from bull puts to bear calls, okay? But before I do it, on the comments box, how is he going with the bull put? If I ask you if I give you a UFO and I tell you build a bull put below the UFO, would you be able to do that? Everybody with me? Give me some confirmation there, guys. Okay. I'm just waiting for your confirmation. Hey, if it's not the case and I went too far, let me know. Okay, yes. Good. Perfect, John. Thanks. Very good. Okay, so guys, so let's move into the bear calls. So to do the bear calls, I'm going to look at my list with neutral short trades. And again, I got a few of them. Okay, so what will you do? Again, Step 1, look at the earnings reports, etc., etc. So let me look at liquid options out there. I mean, I'm not going to repeat TIVA since we did TIVA. What about WIN? Good. Thank you, guys. So I'm loading WIN. Okay, I'm loading WIN. I'm going to load UNH as well. I will load COP as well. CVS is okay, liquid as well. I'm just clicking on those symbols. So behind the scenes, TradeStation begins the download of that market data. But let's go back to WIN. That was the first one I clicked. And hopefully we can plan a trade. Okay, so now in this case, you know, what are we looking for? We are bearish, right? It's a neutral short. So we are bearish. So we want to do the bear call spread. And how do you build the bear call spread? It's kind of the opposite. You would look at the UFOs, and what you would do is, instead of, as we did before, instead of sell a put and buy a put below, that's what we did before, right? So we had this, actually, we had that sequence, but we had it below the green. Okay, now we are not going to do this below the green because that market is in a downtrend, correct? So we're going to do it above the red. But because it's a bear call, then it doesn't use puts. And remember, it's the mirror image. So mirror image means instead of minus P, it's going to be plus C. And instead of plus P, it's going to be minus C. So you sell a call and you buy a call above, right? And the one I'm going to sell is the 127. Why is the 127? Well, because 126.72, it's the top of that yellow box. And therefore, I'm going to sell an option above. Because remember, we are looking for the price. We are looking for the price level on the chart where we expect that stock to not to go. We are looking for price levels in a chart where that market is not likely to reach anytime soon from now until the expiration date. So what would happen? I mean, step 1, WIN. So WIN has earnings on April 24. So we got a month in front of us. Perfect. So what would happen if we look at the options on WIN using March 29, because the sooner the better. So if I look at the 127, they pay 4 cents. Not good. So I go for the next one. 127 pays 40 cents. The midpoint is 56. That's good. Okay, it's more than 35. I mean, it's more than 25, ideally 35. So it's better. So we're gonna go for this one. So if I do 127, 128, because the strike price increments are $1 at a time in this case. So if I do 127, 128, okay, what's gonna happen? Well, what's gonna happen is that I would get paid 56 and I would pay 29, right? So 56 minus 29, that would give me a credit of 27. Okay, and what's the minimum I need? The minimum I need is 15. Okay, that's the minimum. I'm not saying it's ideal. I'm just saying it's the minimum. So we are doing 128, 127. That's $1 of risk times 15%. That is 15 cents. But how much would that spread pay you? It would pay you 27. Correct? So it's valid. Okay, it's a trade you could actually execute. Again, the only thing we need to add now is some mathematical calculations that we run on the options analytic tools, okay, which we will learn soon, where you would now calculate if this market comes to here and you get in trouble, how likely is this to happen? How long is it going to take for this to happen based on prior probabilities? Okay, but for now, it's unlikely because you have 3 UFOs, and the best of all is that the premium collected would be enough it would be enough given our rules, which are minimum rules. Okay. Some of you may say, wait a minute, Jose, I am more picky. Look, your rule with 15%, that's not enough. I want more. I want 40% of the spread. I want whatever. So you could certainly change the rules and make your rules more demanding. But there will be a price to pay for that, which is that you will trade less often. Okay, you will find less trades. Okay, so you always need to look for the balance, and that's why I call this trade valid. Okay, so I'm going to do it one more time, and then we'll call it a day. So I'm looking at UNH now, United Health Group, so that stock is loading here. Like for example, I would not be very happy to do it on that stock. Anyone would like to share on the comments box why, even though UNH is on the list and even though I haven't even looked at the options yet, why is it that I would not be so excited to do this trade on UNH compared to WIN? Let me show you WIN again. So here is WIN. Right? Here is WIN. And here is UNH. Anyone? I'll give you a clue. Let's say you know everything you need to know about options and you are the most knowledgeable person in the world when it comes to options trading. But you buy the options at the wrong time and you sell the options at the wrong time. What would happen? Yes, exactly, Gabriel. Opposite UFOs to close, okay? And plus is 4 of them, okay? So think about it. You know, those 4 UFOs, even though our scanner is telling us that those UNH is in a downtrend and all of these things, where the overall condition is favorable, the fact is that behind the scenes, the algo is identifying 4 UFOs overlapping each other in front of you, and price is actually entering one. So it's actually more likely for this thing to go up than go down. And wait a minute, do you really want to do a strategy called bear call spread that begins with the word bear? Okay, do you really want to do that when the market is more likely to go up than go down? Well, it doesn't make sense, okay? And how do you know that? Thanks to the UFOs, okay? So the UFOs are your ally, big time, okay? With WIN, think about it. There is nothing, as you will see, there is nothing to stop the price from falling. And there is a long room to go. That stock may drop 10% before it gets to the next UFO. Right, so it's a major difference, right? And could it go up? Of course it could go up. But even now, if it goes up, you got 3 red UFOs to defend yourself. You also had this with UNH, right? But you got nothing to stop it from falling. Where with UNH, you know, I mean, you still have the 3 UFOs above with the UNH, but you also have 4 green UFOs below, and we didn't have that with WIN. Okay, so that's a big, an important realization you guys needs to know. Okay. Yes, exactly, Mario. Very good. So, guys, I think we're gonna call it a day. How was today? Give me a little feedback on the comments box. It would be great if you can share a little bit with me. How did it go? Yeah, and again, pleasure as always to spend a couple of hours with you guys doing. Sharpening our skills. Hopefully these sessions are impactful to you guys. That's my intention. If they're not, make sure you let me know, guys, because the reason why we're spending time over the weekend when the market is closed is precisely so we can talk about certain things that during market hours we may not have time, because sometimes we rush a little. And therefore, I'm hoping that this training is bringing value to you. And if it is, great. And if it's not, you just need to speak up, because if it's not and you don't speak up, it's kind of like a shame, because I'm really open and willing to adapt the content of those sessions to what you guys need in the now of your learning curve. Okay, guys. Thank you, Gabriel. John, you attended an options class recently. Great. So yes, good reinforcement. Perfect. This was a very basic session for the people that you have taken options training before, obviously. But remember, we are a mix of people here, so not everybody. So hopefully it went well for both groups, the ones who traded options before and the ones who hasn't. And looking forward to do a lot of options applications on the Thursdays when we get together for the longer term sessions, okay? And so next weekend, probably we will change subject. Next Sunday, probably we'll be talking about futures. There are certain things that we need to address in the futures markets. We also conduct short-term trading sessions on Tuesdays, and many of you have been asking about a little more support in the future side. So we'll pause options for a while. We'll get back into futures, but make sure you all understand, clearly understand that what we have been covering up to now with options is been in the basic side, hopefully impactful to you guys. Certainly the concepts that we have discussed are the way they should be, meaning that it's not like what you have learned is basic stuff and then when you get advanced everything's going to change. It's not the case at all. So everything we have taught is going to remain, but we'll add many more things. For example, mathematical calculation for probability, a series of things that will make your trading even more robust, etc., etc., and additionally more option strategies and so on. Okay, so a lot of fun coming, but again, next weekend we will switch from options to futures. We'll remain in the world of derivatives, but instead of options as a derivative, it'll be futures as a derivative asset. Okay, so guys, enjoy the remaining part of your Sunday. Thanks for joining us, guys. A pleasure. Thanks for your comments, and see you on Tuesday in the short-term session, guys. Bye bye. You guys take care.